Let me tell you something that completely changed how I think about my Aptera investment, and it's the reason I have absolutely no intention of selling my shares anytime soon. This isn't about hype, emotion, or blind optimism. It's about understanding a rule that most investors have never even heard of, yet it could mean the difference between keeping most of your gains or handing a massive chunk of them over in taxes. If you're an Aptera investor or thinking of becoming one, this is something you'll want to understand sooner rather than later. A while back, one of you sent me an article that stopped me in my tracks. It mentioned a specific part of the US tax code that at first glance sounded almost too good to be true. Naturally, I was skeptical, but the more I read, the more I realized this could be extremely relevant for long-term Aptera investors. Before we go any further, let me be very clear. I'm not a tax attorney, I'm not an accountant, and this is not tax advice. This is purely informational. If this ends up being relevant to you, you should absolutely speak with a qualified tax professional who can look at your specific situation. That said, this is something many people, and even some professionals, may not immediately think about, so being aware of it matters. What I'm talking about is Section 1202 of the U.S. Tax Code, often referred to as the Qualified Small Business Stock Exclusion. In simple terms, this provision allows investors in certain qualifying small businesses to exclude a significant portion or even all of their capital gains from federal taxes as long as specific requirements are met. And when I say significant, I mean potentially life-changing amounts. Here's the core idea. If you acquire qualifying small business stock after September 27, 2010, and you hold that stock for more than 5 years, you may be eligible to exclude 100% of your capital gains from federal taxes when you sell. Not a discount, not a partial reduction, a full exclusion. Now, pause for a moment and think about Aptera. Aptera's stock wasn't available until well after 2010. Most of us invested starting around 2019 or 2020. And realistically, Aptera isn't going public overnight. This is a long-term play. That alone means the 5-year holding requirements is not only realistic, it's likely unavoidable. That's where things start to get interesting. Under normal circumstances, long-term capital gains are taxed at rates that can approach 23.8% at the federal level. So if you made $1 million in gains, you'd expect to give up roughly a quarter of that to taxes. But under Section 1202, if the stock qualifies and you qualify, that tax bill could drop to zero. Let's put real numbers on this. If your Aptera investment grows and you realize $1 million in gains, under normal tax rules, you might owe around $250,000 in federal capital gains taxes. Under the QSBS exclusion, that same gain could be completely tax-free at the federal level. That's not a small benefit, that's a massive difference. Now, there are limits, but even those limits are far more generous than most people realize. The exclusion allows you to exclude the greater of $10 million in gains, or 10 times your original investment, your adjusted basis. That greater of part is critical. Originally, I thought it was the lesser of the two. It's not, it's the greater. And that realization alone dramatically increases how powerful this exclusion can be. Here's an example to make this crystal clear. Let's say someone invested $2 million into a qualifying small business and held the stock for more than 5 years. If they later sold it for $22 million, that's a $20 million gain. Because 10 times their original investment is $20 million, they could potentially exclude the entire $20 million from federal taxes. Without this exclusion, that person could be staring at a tax bill north of $5 million. That's not theoretical. That's exactly the kind of outcome this rule was designed to create. So, naturally, the big question becomes, does Aptera actually qualify? Let's walk through that. First, you have to be an eligible shareholder. That generally means you're an individual, a trust, or an estate. Corporate shareholders don't qualify. For most retail investors, this box is automatically checked. Second, the holding period. You must hold the stock for more than 5 years. As we've already discussed, that aligns perfectly with Aptera's timeline. Third, the stock must be originally issued after 2010 to qualify for the 100% exclusion. Again, Aptera easily meets this requirement. Next are the corporate requirements. The company issuing the stock must be a C corporation, not an S corporation. This part confused me at first, so I dug into it. An S corporation is typically used for very small businesses and has strict limitations, including a cap of 100 shareholders and one class of stock. Aptera has thousands of shareholders and multiple classes of stock. That alone tells us it is structured as a C corporation. Then there's the gross asset test. At the time the stock was issued, the company must have had less than $50 million in gross assets. Aptera, in its early fundraising stages, clearly fell well below that threshold. There are also rules designed to prevent abuse. The company can't be using investor money primarily to buy back shares or funnel capital into passive investments. The intent behind this law was to encourage people to invest in companies that are actually building something. Which brings us to another key requirement. The company must be engaged in a qualified, active business. Certain industries are excluded, things like law firms, accounting practices, medical services, banking, insurance, investing, real estate, and hospitality. These are businesses that primarily sell services rather than build products. Aptera is manufacturing a vehicle. It is developing technology. It is building physical products. That places it squarely in the category of businesses this law was designed to support. There's also an active business requirement that ensures most of the company's assets are being used to operate the business, not just sitting idle or invested elsewhere. Based on everything publicly known, Aptera appears to meet that standard as well. So, when you put all of this together, and again, this is my non-professional, good faith interpretation, it looks like Aptera checks every major box, and that's why I'm not selling. This isn't just about believing in the company or liking the product, it's about understanding how long-term investing, combined with smart tax planning, can completely change the outcome of an investment. If Aptera succeeds, and that's still a big if, the difference between selling early and holding long-term could be measured not just in gains, but in millions of dollars saved. So, that's why this is something worth remembering, worth writing down, worth discussing with a qualified tax professional when the time comes. Because if Aptera goes public, and if it performs the way many of us hope, Section 1202 could quietly become one of the most important parts of the entire investment story. And if that day comes, I'd rather keep my gains than give a quarter of them away. Thanks for taking the time to listen. I hope this information ends up being useful to you down the road, especially if and when Aptera's future turns out as bright as many of us are hoping.